Good afternoon, ladies and gentlemen. Welcome to IT Limited 2012 SNET 2013 Annual Results Presentation. Let me introduce to you the management representing IT Limited today. Mr. Shen Kawei, Chairman and CEO. Mr. David Chong, the Financial Controller. And Mr. Benny Fong, Head of Investor Relations. At the presentation, Benny will go through the financial highlights and operation review, and following the presentation is the Q&A section. If you have any follow-up questions, please feel free to raise. Now I would like to invite Benny to start the presentation. Benny, please.
Thank you, Carlos. Thank you, IPR. Now, once again, good to see you all. I mean, it is pretty bad weather here, and as usual, like we're gonna have one slideshow ready for you to cover all the major financials and all the indicators that you probably will be interested in. I don't keep you for too long. I just started here. If you got a physical copy here, we should flip over to page 3, and starting from top line turnover group. For the year, actually went up 14.0% to 65.43 million Hong Kong dollars. Gross profit up 8.7% to 38.49 million. As you all know that a lot of the retail market is still under the pressure of the sluggish global macro environment. So a lot, as we share with investors like 6 months ago, we've been offering more promotion activities, including markdowns over the year. As a result, GP margin has been down by 2.9% to 58.8%. And the reason we're doing that apparently is to boost the top line sales. And if we come down to the operating profit, it was down 17% to 476 million Hong Kong dollars. That gives you a profit margin, operating profit margin of 7.3%, down 2.7 percentage point. Net profit down 18.6%. If you recall that we were down about 21% in the first half, meaning we did better in the second half. That added up that narrowed down the drop in terms of the growth in net profit, and that giving you 385 million Hong Kong dollar to round up the year. Net profit margin 5.9%, down 2.3 percentage points. Basic earnings per share down 20% to 31 cents. Diluted earnings per share down 18.9% to 30 cents. We're proposing a final dividend of 3 cents for the year. And that's pretty much the top line figures on the group level that we would like to share with. Break it down on the turnover level, break it down a little bit by regions. Hong Kong still our first #1 market, accounting 56.7% out of the total turnover. By revenue, it went up by 8.8% to 7,308 million Hong Kong dollars. China, #2 market, accounted for 31% out of the total turnover, itself up 32% in terms of revenue. Japan, third market, accounted for 7.9% out of the turnover. We got a pretty good high base last year, so in terms of the growth, in revenue for Japan has diminished a bit by 8.1% to 514 million Hong Kong dollars. Others region, meaning Taiwan and Macau, altogether up 24.4% to 284 million Hong Kong dollars. Same turnover manner, but divided up in terms of our key product lines. As you all know, we have 3 major product lines, namely in-house, international, and licensed brands. In-house brand continue to be our major, very major product line, generate the most profit. It accounted for 59% of the total turnover. It itself up 16.4% in terms of revenue. International brands, #2, account for 38%, close to 39%, itself is up 14.2%. Licensed brand, down 27% in revenue, accounted for about 2.2% of the total turnover. Now, this is slide that we share a bit more on the GP level is a relationship between GP dollar and GP margin. As I mentioned earlier, more promotion activities have been offered during the year to stimulate the top line sales and of course to defend our market shares. Therefore, as a result of more of these activities and including markdowns, GP margin went down 2.9% from 61.7 to 58.8%, while GP dollar went up by 8.7% as shown here. Now, after GP, we got operating profit level. We break it down a little bit here. And we started from Hong Kong, operating profit actually down to 23% to 274 million Hong Kong dollars. Apparently this is mainly due to the shrinkage in GP margin level and a bit surging in the operating costs here. Mainland China down 36% and ended up with 92 million Hong Kong dollars. Japan. In previous slide, you probably just that we just shown that on the top level of Japan business, it was actually down 8%, and on the OP level, it went up almost 3 times, meaning we have achieved a pretty good operating efficiency here in this segment. Others, once again, Japan plus Macau, down 4.3% to 55 million Hong Kong dollars. Now, that's what we got you for the profit side. Now we take a look at the cost side. On the group level, I think the operating cost ratios remain pretty flat, actually. It actually went down 0.1 percentage point to 51.1%. Break it down a little bit to staff costs. The staff cost ratio on the group level actually went down 0.3 percentage point to 15.1%. When ratio up 2 percentage point to 23.3%. Regionally, operating costs for Hong Kong, for the Hong Kong region, operating cost ratio remained exactly flat, meaning 50.4%. Cost ratio for China, actually slightly went up by 0.2 percentage point to 53.3%. Here, some more financials indicators or ratio that you probably would be interested in looking at. Starting with cash, we sitting on over 960 million cash at the moment, as at end of February, versus 226 last year, same time last year. We're in a net debt position of 73 million versus pretty much the same level last year. Stock turnover days marginally stable, 166 versus 164 last year. If you recall, 6 months ago when we communicate with a lot of investors, both sell side and buy side, we said one of the very top, one of the to-do list, like on the very top of the to-do list this year is to boost the top line, at the same time to digest to clear the inventory a bit more. And I think we did pretty well, especially as you can see from the stock turnover days as at the second half. We went down actually 31 days in the 6 months, ending up once again 166 days here. And total debt to equity ratio 14.5%. Total return on equity 16 versus 22.9% last year. Now, footprint. It's pretty straightforward here, so I probably don't go into line by line. In conclusion, that we managing as at end of February, the group is managing 587 self-managed stores, a net increase of 50 stores, and in terms of sales area, up 11.4%. And the bottom part is our franchisee business accounted for a minor percentage out of total turnover, so maybe I just leave that to you. Now, from the previous slide, you see that sales area went up 11.4% on the group level. Revenue went up 14%. Inventory in terms of dollar in nominal term went down, actually. That tells us one thing, that we have achieved some operating and inventory efficiency here. That's pretty obvious, I think. And a pretty good measure here that we can share with is the inventory versus sales footage here. As you can see, the numbers really it's been coming down from 971 million to $833 here, which is a pretty good measure for that manner. Pretty much to round up this presentation by just a key few messages to share with. This year, I believe quite a few Asian retail markets still under the big pressure of the macro environment. Not really a lot of markets been seeing good recovery. I'm sure you probably know more than I do. So what we're gonna do still in this forthcoming year, we still stick pretty close to our strategies of last year. Now we call it last year. We will continue to boost the top line, meaning to stimulate the top line sales growth. Is one of the staying on top of the to-do list. Continue to monitor the costs and further enhancing our stock turnover efficiency is something that we will continue to be very focusing on. For growth, I think from regional perspective, I think China still will be one of our place that we're going to be very committed in, especially from medium to longer term. Number of reasons, I'll just share a couple ones. By just looking at the group of middle income group or the household per capita spending, and their spending on luxury products, including apparel, it's been rising every single year, very steadily. So we got good reason to believe that why we have to be so committed to this country, and especially from medium to longer term. So you will see that our growth rate and expansion rate in this country should be the fastest among all our operating regions at the moment. As you know, we actually were born in the '88. And now this year was actually our 25th anniversary of IT. We really, to be honest, we have a lot of marketing campaigns, brands collaborations, crossovers. A lot of activities have been lined up for these celebrations, and most of them will be happening in the second half. So, well, one can expect that. And other activities include our first department store with Galeries Lafayette. It's scheduled to be open in the third quarter of this calendar year, and also this year is another 20th anniversary for one of our very well-known brand, 8. So a lot of marketing activities will be going on this year. The group chairman and ourselves will be really exciting for this year. Looking very forward to the success of this coming year. So I think that's pretty much my presentation to you for today, and hope you find it helpful and straightforward. Thank you.